Hello ladies and gentlemen, and welcome back. In today's video, we take a look at everything to do with the markets around the world right now, including stocks, commodities, and cryptos. But more importantly, we need to talk about the Federal Reserve and their stance on inflation moving forward. As you can see, the market did end up going down, and what might surprise you is the day after this report, leading into the trillions of dollars of options expirations on Friday, and also how important it was to hold the lows. Well, welcome back everybody to the Daily Show. As per usual, we'll go through the news, the macro stories, the lead indicators, and then of course the chart and the key levels that you should be watching right now. So Powell says the Fed will not change its 2% inflation goal. He's very, very adamant about this. The Fed is also currently betting on strong jobs markets to potentially keep the US out of recession. When you look at their forward guidance, though, you might realize that they're just not prepared to say the recession word, and that is fairly normal. Let's take a look at the dot plot in terms of what the Federal Reserve expects during the next couple of years. And there weren't too many major changes here. Basically, the Fed is now saying that by normal 2025, they expect to be at around 2.5%, and then they expect to be holding that level. So many rate cuts to come in the horizon. However, there's still a pretty wide range in terms of where the median expectation here is from the Fed terminal rate and possibly some of the rates throughout the next couple of years. When we scroll through and we look at some of the 2023 projections they're coming out with, real GDP 2023, 0.5% down from 1.2. Now, this is interesting. They're starting to lower their expectations, and they've got a wider range now on the negative side. Again, they're not going to say recession. They'll never say that word, but they are starting to bring in some of the figures to look a little bit more, we would say dodgy, and obviously the Fed's remaining to be hawkish here. Unemployment rate 4.6% up from 4.4%, and then of course inflation still showing that it could be quite sticky throughout 2023, 3.1 now up from 2.8. So what did the Fed do? Well, it did its best job to potentially try to stop the bulls in their tracks. Effectively, Jerome said, don't buy the S&P 500. In many ways, that's actually what he was trying to tell. He was trying to say, I don't want it up there. The Fed doesn't want it up there. Let's see if we can stop this right here. Let's see if we can continue to tell the tale of the market being very, very sick. Whether it is or not, we don't know really yet. We can assume that, of course, companies and things like consumer discretionary, the American consumer is sick, but the Federal Reserve is not trying to tell you that it's all good and everything's fantastic just yet. So stocks have sold off on Fed Day lately. That ended up being the session. It wasn't a huge sell-off, but it did. The next day, though, is usually the big one. And you'll notice here that predominantly it's been negative. And if it's been negative on the day of, it's been negative the next day. Will that happen again? Well, statistics would start to be going in your favor for that. Let's have a look at what the Jerome Powell and the Fed are going to have to do over the next couple of years. And the big one here is, of course, the Fed will keep hiking until the federal funds rate is greater than the CPI. And that's starting to get a little bit closer. We're sitting at 4%, now 4.5%. We're going to probably be at about 4.8%. And you would expect that inflation will be probably underneath the federal funds rate somewhere maybe around March of 2023. That's the ideal kind of level here, March to maybe June, July of 2023. In all other times that this has ever occurred, this has been the right thing for it to do. Then they've been able to pivot and, of course, start cutting the rates to support the economy. This remains one of the X factors of 2023. However, we know the other big problem is always going to be valuations of stocks. The market may compress around this time. Remember to come and follow us over at FX Evolution on Twitter as well, as we're always posting some good memes, but also we've got some great information here. And this is the federal funds rate futures moving forward. And you can see the terminal rate still looking around that 4.8%. And the only real change since the FOMC statement was a slightly higher bottoming. So you can see here, as of the 14th of December, it's still very much similar to the day before after the inflation result. A lot of cuts coming through, and then maybe a slightly higher, due to the dot plot most likely, leveling base at around 3.25% until 2025. So interesting to see what the Federal Reserve thinks about the market. Obviously, let's look at some stats now. Let's look at some macro data to tell us what things have happened in the past when we've seen similar events. So yields are closing at multi-month lows. Now, that's good and bad. It probably means that the worst of the yield rises are behind us, but it also tells us a sickness is in the economy. This is the first signal after 252-day high on the 10-year bond yield. If you take a look at when 10-year bond yield after 100% of the treasury yields close at 2-month lows, you can see the previous periods. We've got a little bit of data statistics around this. And in general, you'll notice over the next 6 months, yields tend to drop. And that's going to be a good thing for bonds traders, specifically probably treasury traders, TLT, etc. If we look at S&P 500 after the 100% of treasury yields close at 2-month lows, in history, it's been an okay signal for the bulls. You can see that it has been quite good statistically, though we need to go back to the 70s and have a look at some of the data points over there. Some of them were good, some of them were short-lived, and then there were drops on them. And there was also some in the 80s where we ended up getting a decline in the markets. It's not conclusive that this particular time means, oh, yes, let's go bullish and let's feel so great about it. What is interesting though, and this is always the way that the markets tend to go, is if we do have a huge amount of decrease in treasury yields, historically the better sectors that have performed well have been information technology and usually something like consumer discretionary. Now, these are the two sectors that usually take the US economy out of recessions and, more importantly, into very, very nice periods in the market, bigger bullish periods. Semiconductors also tend to perform well over this time. So remember, dropping yields, some of the most hated sectors at the moment, not semiconductors, are consumer discretionary and are information technology. These sectors may be the better performers in 2023, and it's certainly shaping up like that could be one of the places to look at. Let's move over here to our MACD signal that we got before all of this crazy news, and then we'll move over to what that meant for the market. Remember, the data points we do have very negative for a period of time, let's say the next 3 months to 6 months, and then historically, we start to get that turn more to the positive side, which markets are usually on. Remember, it pays to be an optimist. Being always somebody that thinks the market's going to go down technically isn't going to pay the bills over a 10, 15, 20-year period. Conditional seasonality, we know that we're coming into the Christmas rally theoretically, but that doesn't happen during usually bear market years. Here's just another way of looking at it. Here's where we are right now. Of course, in December, we're in that middling point. Around the 15th, 16th is usually where you see that bottoming low for stocks, and then you get the Christmas rally if it hasn't been a bear market year. Will Santa come? Well, time will tell. All right, well, just before we jump into the charts and we take a look at all of the key levels that you should be watching right now, I'd like to thank today's sponsor of the video, which is Tiger Brokers. If we take a look through here on the charts of the heat map, you'll notice that the sector rotation has changed slightly over the last week since we last looked at this. We used to have oil and gas being the most hated sector of the markets, and it still is definitely disliked in recent weeks. But we've got automobile manufacturers and banks that have taken the biggest hit since the core inflation numbers and, of course, everything else that's happened with the Fed. Let's have a look here. Diversified banks over the last 5 days were negative. And if you'd recognize this particular movement in the markets, which we were talking about in our daily show, then you would notice that even over the last 24 hours, banks took not the heaviest hit, but certainly a considerable one, while markets moved into defensives such as pharmacy, aerospace and defense, utilities, restaurants, those types of things. So the market was clearly in more defensive attribute over the last 24 hours. You need to have a platform that allows you to see these types of things. And of course, Tiger Brokers does do so. Do remember as well, being able to check the last 20 days of performance of all these different subsectors as well can really help you to see that there are two markets or many sides to a market. You might think over the last 20 days, everything's been bad. Well, it hasn't been bad if you've been in water utilities, silver, tobacco, I guess, pharmacy, any of those types of sectors, but it has been very poor if you've been in some of the worst ones, which have been oil and gas, home furnishings, shipping, those types of ones. So check out the Tiger Brokers platform if you're interested in some of these features and the special offers in the description down below. Remember, there is one free ANZ as well for stock for Australian and New Zealand audiences, plus a whole bunch of other specials if you meet the T's and C's. So check them out. So let's move over now and have a look at the markets, and specifically let's take a look here at what's going on with volatility index. And you'll notice that the volatility index is fairly smashed. So basically we've seen volatility drop through, and that's because this week was all about implied volatility. If we go down to the 2 hours, you'll see just how much has come off since the FOMC statement and the CPI. It wasn't because the market was going down, remember, it was because the market actually was going up, and we knew that inflation numbers on average are moving the market around 5% during the day over the last couple of announcements. So that news has now come out. Now we go back to, okay, volatility will only spike if the market starts to probably get fear into it. So do we have similarities with the previous spike? Yes, we do. Do we have pullbacks? Yes, we do. We're sitting at 21.16. You probably want to see bearishness come through in the next couple of trading days and the VIX starting to spike up again for it to be similar to last time in terms of the drop. That's what we're probably looking for in these markets. Let's move over to the US 2-year. US 2-year, little change after the Fed's statement. I think the Federal Reserve is just basically saying, you know what, we're going to hold put. We are not changing our 2% target. We're not doing anything. You guys think that we're pivoting right now. Well, we might, but we'll do that in the future. That's pretty much what they've been saying. High yield bonds dropped on the session. Interesting. Certainly something we're watching very closely. Remember, if high yield bonds drop again and again and the market stays solid, it's a great precursor to bad things occurring. What about TLT? Let's have a look at TLT for the session. Probably one of the favored trades of a lot of people out there at the moment. Well, that was up 0.43, just consolidating at a very tough zone for it to get through. I've still got a green area down here at 102. But look, medium to long-term investors, they still will like TLT, and they'll like what they're seeing in terms of the forward yields as well. There's more upside, but a lot of that initial upside has already been had. Bonds are suddenly exciting, I guess you would say, in 2022, and they'll continue to be relatively good, you would think, for the next 6 months in 2023. Let's move over to PCC. Put call ratios. Put call ratios jumped up. Again, puts were purchased throughout the session, and we're looking mostly, if we think bearish on the market, for this to be as low as possible to allow, of course, the markets to potentially go down. We'll talk more about that when we bring up options later on in today's video. Let's have a look at the US dollar. So the US dollar is continuing to weaken. It actually just went down to the extreme low wick over here. There's not much to really like about the US dollar at the moment. It looks weak. It's broken into this demand. Yes, it's not shown us any signs of recovery at all. We've got alerts set to these highs for a big change in events, but it looks like the US dollar probably has also started to decouple from the stock market. We won't necessarily, I believe, over the next year be using the US dollar as much to say, okay, US dollar up, stock market down. This happens. There are coupling times and decoupling times for the US dollar, but you can see here that it's weakened off. It's still potentially around that area, but at the moment, retail traders are really trying to buy US dollars and sell euros, and it's just not working out for them. So we'll continue to watch that space. Let's have a look at gold. So gold got that spike through and it made a new high earlier this week. We do know where we've set alerts. This is going to be a critical zone moving forward, 1776. I want to see a low broken there for gold to weaken. And there's more than one reason. Look at the trend line that we've got through these series of higher lows. Imagine if we're able to actually break that down. A lot of people will be drawing trend lines through these highs and these lows and saying, look, this is dulling, and there's a really good chance that it could break down. We don't know that yet. If it does, and the US dollar miraculously finds demand, at least short term, then gold may weaken down through. At this point, I would be neutral to bullish on gold still. That's the trend. That's how you have to look at it, unfortunately. Weekly close is a huge deal here. Make sure to watch the weekend video this week. We're going to get a lot of information from the weekly closes about where these wicks are. Notice high, low, open, close, pretty much the same level. currently looking like a doji. If you then get a break to a new low or a new high, we know what this was. It was an accumulation or a distribution, whichever break way it goes, and we'll have a lot of information about where to place excellent positionals moving forward. And that's, I think, the key thing here is there's a lot of good trades potentially coming up. US oil hit into our little supply zone. It's found a little bit of sell-off here as it's moved through. Obviously, this we've been talking about now for 2 days, I think, and it's come back in. We're looking for turn stories here. And at the moment, the only level that we know is a critical break for oil to resume selling is going to be somewhere around that 74.70. At this stage, we're at kind of a supply becomes a potential sell zone. It's having a reaction. Will it have a very strong reaction? I want to see it back underneath there to then prove that the markets wish to go lower. Trend is currently down. Most people are now suddenly bearish on oil, so we do need to remember all of that. What other things do we have coming into this though? Let's look at the 2 hour actually, so we can draw that up. And what you'll notice is that we're coming back into this trend line. So I like this area quite a lot for oil. Let's find out whether the sellers really do have commitment here. If it breaks up, then pulls back down here, I still think that that could actually insinuate a little bit of bullishness. For us, medium long still remains to 65, 66. I've been bearish since 120 on this. So we'll find out, first level was 75, next level 65. Still aiming for it at this stage. It's at a critical zone. Oil certainly one to watch. Another one to watch has got to be Tesla. So we know that 150 has huge amounts of puts on it. We'll check that out in a minute. We also know that this is a hated stock at the moment, and a lot of retail traders are continuing to buy, claiming, and I've seen this claim a lot, that this is the greatest capitulation of Tesla that's been seen in some time. Well, not really. I mean, these capitulations were massive. I mean, these were huge legs down. This looks scary, but we have to put things in, I guess a little bit of history and a little bit of context. There is a gap that hasn't been closed from a massive rally at 136. We know that consumer discretionary is not popular right now. We also know that it's highly likely that Tesla will not want to close below 150 by Friday. Why? Well, it's got to do with options. Let's look at the weight of evidence. Now, a lot of options were closed. Also, someone went crazy on 190 calls literally just the other day. Look at that. They just opened all these 190 calls. They went wild. So we've got 190 calls all over the place. We have the 150 puts, which look insignificant now. And I'm not sure if these guys are going to make any money, but 190 calls just came out of nowhere there. So 150 was always our put strike where we thought that the buyers may recommit. We're so close to that level now. By Friday, you would probably not expect it to be below that point. You would also not really expect 190 calls to get paid off as well. 1.658 million units on Tesla. Decent amount coming into the quadruple witching. Let's move over now to what's going on with, of course, Apple. A series of lower highs coming through. We still haven't seen any bullishness out of this stock. It held okay. I mean, it's down 1.5% on the session. Again, it's just not very strong looking. I mean, a series of lower highs. We know where the break lows are, 140, 134. If it goes through 140, where's it most likely going? 134. If it goes through 134, well, then we start talking about serious pullbacks in the market and, of course, potential really great opportunities moving forward for buyers in this market if they can hold off and, of course, if we end up getting those levels. Consumer discretionary versus staples. This has been showing us again that the market is overall still moving a little bit defensive. It's not picking up the sector that you usually see coming out of an economic recession or an economic failure. 1/3 of the American economy is consumer spending. You know what? The stock market doesn't like these stocks. Amazon and others are all struggling. Let's just take a quick look at Amazon. You can see it's almost on its lows again. And this is just, I mean, it's a great stock, but it's just down here. This is where it is. There's going to be opportunities on this sector in 2023, you would have to think. XLF, let's move over here. Now, interesting. So we got a high, a low, a higher high, a lower low. Then we thought it would rally and then would sell off. That's how it looks at this stage. Let's take a look at the weekly here, just to get a bit of an idea on how bad it would look if it closed like this. Check that out. Look at that rejection wick. So many sectors setting up this way. Keep an open mind. It still could be part of accumulation. There's a potential that buyers may come in. It's just not looking that way just yet. Semiconductors, similar, bounce out. Anyone that knows Wyckoff styles here would know that this looks like kind of a UT or a UTAD, potential false break to the upside, sell back down, make a lower high, potentially breach that 210. It's just not looking fantastic at the time of this recording. It's hard to see it, but this is what you've got to do in trading. You've got to say, okay, what's the weight of evidence? Each time the market comes down to this level, it's not like we're seeing wick purchasing. We're just not seeing that. We've got mostly these kind of potential false breaks to the upside. That's the best sector in the market, semiconductors. So it's not looking so good. Industrials, the one that's been talked about, again, a break to the upside during the CPI number. I wonder how many people got trapped into that. Now we see the FOMC and it's held the lows. It didn't just rally back through. Is that telling? Is that showing us that the markets want to go lower? Again, we haven't got new lows. We haven't confirmed it, but we're there. Let's look at the DAX. This is a 2-hour chart. Another very interesting setup. Look at this. Look at this, a potential false break to the upside. What if we now make those weekly closes, come down, swing a low high? All of a sudden, you guys know what that looks like. It's not positive towards the markets. It could be, it's not yet. The weight of evidence still looks fairly negative. Here's the US 100. Here's the downward trend. Again, rejection wick. Not so good, is it? We don't know what's going to happen next. Long leg doji off the FOMC. Of course, if we get a new break to the low, you've got to think that's a very negative thing. Because what will that have mean? That would mean that people got trapped into longs in this area. The wick rejection is currently the key. If it closes above there, well, you've got to probably admit defeat as a bear and say, well, on to the next zone, 12.8, etc. We don't know that yet. We'll continue to watch it. US 30, let's move over here. Another one with these big rejection wicks. Another one setting up potentially in some form of trap distribution. Is it a trap distribution like we saw in energy? Well, we're watching it with open mind and the ability to see both. A lot of people have liked the Dow recently. If this starts to fail, the old economy versus the new economy, we've talked about a lot of times on this chart. Make sure to subscribe if you're interested in that type of context. And we're just not seeing strength yet. Let's look at the US 500 now, the S&P, the all-important one. So we'll get rid of this little box here. We know that 3,900 is just super key. We also know that this was a super level which had things like gap closes. It had monthly, weekly, daily closes in the past. It went through the trend line. It would have trapped people into buys initially that morning. It would have trapped people into trying to buy the rally of the CPI number. All of those types of things will have occurred here. At this time of recording, we can keep an open mind to two things. If we get through this 4,050 kind of 8 level, let's look at a 15-minute just to present why this is an important zone. Notice the drop, the basing, the drop, the pull up to the level, then the switch. And at the time of this recording, it actually looks bearish. Okay, at the time of this recording. But if we take this high out again, you've got to say, wait a second, we've got a low and a lower low over here. And all of a sudden we're breaching to that upside. Why are we doing that? Why are we going higher again after making the lower low from the FOMC? Shouldn't this just be a pullback to potentially position further shorts if it's going to do it? You'd probably think that's the way it is. It's not super high statistical style trading, but with the weight of evidence, the wick rejection, the information here, and then of course the target of that 39.10, 39.15, 3900 area, that would still make some sense. We breach below that. Let's say a scenario like this happens. Market comes down, market bounces up, or even market breaks a new low, market bounces up, goes a little bit deep, that's scary for people, and then comes through. Would that make sense to the options and where we're seeing the chain? Remember the price, 4,000 on the dot. Let's take a look here. In fact, we'll refresh it just so we can see if it's come through with anything new. Now, one thing I did notice was that some options have been closed on the 16th. So let's have a look here. So it's only 5.96 now. So some options were, effectively they were closed off, matched off. Now we know 420, they're not getting paid. We know 380 is not getting paid. And what this should prove to you is that when everyone's jumping on something, an idea, that doesn't mean you go and say, oh, what a great idea. Let's go jump on this strike. Well, actually, No, that should be where you're thinking, okay, well, maybe I want to sell premium on those strikes because everyone else is doing it. It's actually in the favor of Wall Street, who is selling the premium, not to finish at those levels. So you're probably pretty sure we're going to be in a slot. And that slot was between 420 and 380. Yes, it's wide. Then we get max pain here. We're currently above that 391's max pain. We know that 390 is literally a big demand support level. Would it make sense by Friday to be there? Well, technically, yes. Does it guarantee it? Absolutely not. And we know that in between, anything's actually pretty good for Wall Street. So that 390 level, if we get back down to there, you'd probably see Tesla sitting about 150. You can see the synergies. Go through your stocks, you might see it. So interesting zone, certainly a very key point. The bigger put here is still sitting at 390. And obviously we have the calls here. Anything in this area between 400 and 390. I'm sure that will put some lobsters on the table for Wall Street going into their Christmas hampers. Let's move over to Bitcoin, move into this area. 18,000 was reached. That was previous supports. I guess it's acting as resistance. Look, Bitcoin's been tough recently. We still think that overall there's a lot of negativity that can come through on this one. Notice we made a higher high. Maybe if you want to see breaches below short time frame, you want to see break below 17,626, any rally, then you would think short term is going to be met by seller demand. Interesting level, big rejection over the last 24 hours. So this is the current thought process there. Still more news ahead. We've got a whole bunch of central bank policies coming through. We also know that we have core retail sales, 8:30 a.m. New York time. And then we go into Friday, which is going to be even more news with the flash services PMI. On top of all of this, we do have quadruple witching. So that's going to be trillions of dollars at stake in options. We will update you over the next 24 hours on that one. So make sure to check it out. Remember to subscribe, smash that like button. And as always, if you're interested in any of the special offers of Tiger Brokers, click the links in the description down below. Why not give it a shot? There's a great platform there. And of course, it gives you some excellent features that we checked out in today's video. Thanks so much.